Exercise 11-15, we're going to be working with a note payable and then its corresponding interest. So on August 1st, purchased equipment costing $16,000 by issuing a 1-year 9% note payable. So out of this transaction, we are getting equipment. And because we have more equipment, that means equipment is going up. And equipment is an asset, and assets go up with a debit. So I'm going to put the $16,000 as a debit for equipment. And did we pay cash? No, we gave a note payable. And note payable is a liability, and the liability is going up, therefore it is a credit. Now some students want to try to calculate interest, but on the day that we issue the note on August 1st, no time has elapsed. Because remember, the formula for interest is principal times rate times time. No time has gone by, so on the day that we owe, or the day that we issued the note payable, there is no interest yet. And then we need a explanation, purchase equipment exchange for a 1-year 9% note. So notice this was on August 1st. So it is now December 31st, and it says accrued interest on the note payable. So from August 1st to December 31st, every day we owe a little bit more interest, but we don't record that interest payable every day. We wait till the end of the year. Because at the end of the year, we have to create the financial statements like the balance sheet, so we have to show all of our liabilities as of December 31st. So we have to record accrued interest. And what does accrued mean? Accrued means something is accumulated, in this case interest. So interest is accumulated but is not yet paid. Now notice we're not going to pay it on December 31st. We just need to show how much interest we owe. So now we have to calculate how much interest do we owe. Again, the formula is principal times rate times time. So we owe interest from August 1st till the end of December. So the beginning of August to the end of December. So that's August, September, October, November, December. That's 5 months. So we're going to plug in the numbers into our formula. Principal is $16,000. The rate is 9% times 5 divided by 12, and that gives us $600 of interest that we have accrued, or we technically owe, at the end of December. So we have to show an interest expense. And so why am I debiting interest expense? Because we have more interest, and expense increases on, I should say we have more interest expense, and expenses increase on the debit side. Therefore, I am debiting interest expense. Now remember, we're not paying the note payable, we're not paying the interest on the note payable until a year later. A year, I should say, from August 1st. So at the end of December, we're not paying any interest, so we just have to increase interest payable. And why am I crediting interest payable? Because it's a liability. We owe more, therefore it's increasing, therefore that's a credit. Accrued interest expense at the year end. So this is just an adjusting entry that the accountant would do. Most bookkeepers would not do this type of journal entry. Now it is August 1st, so it's a year after we got the equipment by issuing the note. It says we paid the note payable plus interest at maturity. So let's just start with this note payable. So what happens to this note payable once we pay it off? Well, it goes away. So how do we make a liability go down? With a debit. So I'm going to copy and paste this 16,000, and then I'm going to lower notes payable. Okay, remember at the end of the previous year, so on December 31st, we showed that we owed interest of $600. So what happens to this $600? Because remember, we're going to pay the note payable plus the interest. So we have to get rid of this interest payable. So I'm going to copy that, paste it. So interest payable is going down. And then we need to show how much interest has accumulated from December 31st to the beginning of August. So what months is that? That's January, February, March, April, May, June, July. So 1, 2, 3, 4, 5, 6, 7. So again, we have to show the interest that is accumulated from the end of December 31st through the beginning of August. So we can't count August. So that's 7 months. So how do we calculate that? We have to use our principal times rate times time. So the way I calculate it is $16,000 is principal times 9%, which is 0.09, times these 7 months divided by 12. That gives us $840 of interest. So we have, notice we're calculating a total of 12 months of interest. We already have the 5 months from August to the end of December, and now we have 7 months from January 1st to the beginning of August. So I'm going to have to record this $840 of interest expense. So if you're curious, here is the 5 months of interest expense, and now we've just calculated 7 months of interest expense for a total of 12 months of interest. Why 12 months? Because it was from August 1st of 2023 to August 1st of 2024. And then we're going to pay cash. So there's 2 ways to calculate cash, and you should do it both ways. So the cash payment on August 1st, notice going back up here, we purchased equipment costing $16,000 by issuing a 1-year 9% note. So we're going to have to pay back the $16,000 plus 9% of $16,000. So that's what I'm calculating here. $16,000 principal plus 9% of $16,000. So if you take $16,000 times 0.09, that gives us $1,440 interest. So the amount of cash payment is $16,000 plus $1,440. So that's a total of $17,440. Now we should also double check. So if we take this amount plus this amount plus this amount, in other words, our debits must equal our credits. And they do. They equal $17,440. So the last thing we need to do is we need to show our comment, our explanation, see paid note and interest at maturity. And that's it.